Kim Hughes, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. You can go to sanecrypto.com/retirement to sign up for my free online training called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further. Now, one question I get a lot is about investing in companies that may somehow benefit from cryptocurrency and blockchain rather than, or maybe in addition to, investing in the crypto assets directly. In fact, here are two different questions from the AskKim at sanecrypto.com mailbag covering both aspects of this question. First, Bert wrote, "It seems to me that there are two main focal points concerning blockchain technology. One is the secure ledger feature that makes a store of value possible. The other is the potential for blockchain to streamline back office accounting/auditing functions, thus cutting the cost of business while creating a product for consulting implementers to sell. Cryptocurrency investing addresses the first. I'm intrigued about the potential for BLCN, the Reality Shares NASDAQ Next Gen Economy ETF, that's a mouthful, to address the second. Your thoughts?" So I actually think Bert really shortchanges blockchain in terms of its potential. I think it's much bigger and broader than that. But so he was asking about using an ETF to invest in those companies. So more on that in a second. But Doug's question was, "Kim, do you see any opportunities to invest in companies that support cryptocurrencies? There must be all kinds of computing hardware support companies that will benefit from increased demand of computing power, graphics, etc." Okay, so slightly different spin on basically the same question. And by the way, thanks to both of you guys, Bert and Doug, for your questions. Really appreciate them. Now, before I answer, let's take a minute to define some of the terms that were used in these two questions, starting with the basic ones, blockchain and cryptocurrency. Now, you've probably heard of Bitcoin. Bitcoin was the first cryptocurrency, and it was also the first blockchain. Blockchain is the technology that underlies all crypto assets, not just Bitcoin, in much the same way that the internet is the technology underlying email. In fact, I like to explain it as one of those old standardized test questions. Blockchain is to internet as Bitcoin is to email, meaning internet was this obscure technology that no one really understood or knew what to do with in the mid-90s, other than, a couple of computer scientists, until AOL started mailing out millions of CDs. And suddenly email became the killer app that opened the floodgates to widespread mainstream adoption of the internet. Well, today, blockchain is the new, obscure, potentially disruptive technology. And Bitcoin, replacing gold as a store of value, much as email replaced fax, is the first compelling use case that's starting to drive widespread mass adoption today. But it's not the only use case. In much the same way we couldn't possibly imagine back in 1998 how ubiquitous internet would be 20 years later, many people believe that blockchain will be equally transformative, also in ways that are yet to be imagined. For now, our ability to invest in that future is somewhat limited, just as our ability to invest in the internet was back in 1997. Right? Your choices are to buy crypto assets like Bitcoin and Ethereum directly on an exchange that specializes in those assets, just like you buy stock through a broker on a stock exchange. Okay, works basically the same way. Or you can invest indirectly. In episode 17, I answered a question about whether GBTC was a good alternative to buying Bitcoin directly. If you want to find that show, just go to sanecrypto.com/podcast and look for episode 17. I'll put a link in the show notes as well. So GBTC, in case you didn't hear that episode, is the ticker symbol for the Grayscale Bitcoin Investment Trust. Okay? An investment trust is a company that owns a fixed amount of a given asset, in this case, Bitcoin. And investors, they don't buy the Bitcoin directly, they buy shares of the trust, which is really a contract that represents ownership of the asset held by the trust. So in a gold trust, for example, one share might be worth 1/10 of an ounce of gold. Well, with the Bitcoin trust, one share of GBTC is worth roughly 1/1000th of a Bitcoin. So I did that show a couple of weeks ago, but I think these numbers are still pretty accurate. At the time, the trust held about 182,000 Bitcoins, and there were about 182 million shares of that trust outstanding, right? So each represents an ownership of about 0.001 Bitcoin. That's how you get to that 0.11,000th, okay? And the trust is managed by a company who charges a fee for that. And in the case of GBTC, that company is Grayscale. Now, initially, all of Grayscale's investment trusts, they have others for other crypto assets, were sold only to individual accredited investors who have very large minimum purchases, and there were long lockup periods. But then after a period of time, they listed the shares of the Bitcoin Investment Trust on the over-the-counter market, known as a secondary market, so that the initial investors could sell their shares on the open market, and individual investors like us, even non-accredited investors, could buy them at a market price very similar to buying a stock, where the price can float up and down based on supply and demand, okay? So again, just to give you an example, today you can call up your stockbroker or go online to your brokerage account and buy a share of GBTC for roughly $14 US, okay? And at the moment, GBTC is the only way you can buy and sell Bitcoin directly through the stock market or through a stock broker, okay? Although there have been many applications for a Bitcoin ETF, which will undoubtedly come someday. So far, the SEC has not approved any, okay? So GBTC is, for the moment, the only game in town in terms of direct investment in Bitcoin through a traditional stock trading account, okay? But that isn't exactly what Bert and Doug are asking about, okay? They are asking about investing in companies that are involved with or benefit from blockchain technology. Doug is asking about buying them directly, I think. He didn't really specify. But Bert is asking about buying an ETF, right? That next gen economy ETF, which has a ticker symbol BLCN. It's one of 5 different blockchain related ETFs that have been offered so far, right? And so just to make sure we're all on the same page and make sure you understand what an ETF is and how it's different from like a trust and all these other things. ETF stands for Exchange Traded Fund. And Vanguard says that investing in ETFs combines the flexibility of trading individual stocks with the built-in diversification and low costs of mutual funds. Exchange traded part of the ETF means that it's traded on a major stock exchange, like the New York Stock Exchange or the NASDAQ, right? It's just like buying and selling a stock, okay? And then fund, the fund part of ETF means that it is a collection or a basket of 10, hundreds, sometimes even thousands of different securities, stocks, or bonds in a single fund, similar to a mutual fund, okay? All right. All right. So with all that out of the way, okay, let's talk about my answer to the question. So in a word, my answer is no. Meaning, I do not invest in the blockchain space, in blockchain companies, as Doug and Bert suggest. And I'll tell you why. First of all, I think investing in blockchain related companies is a little bit like betting on a horse because you like the name at this point. First of all, it conflates the technology with the investment, and they are two very different things. It is very possible that blockchain could be wildly successful, much like the internet, and prove to be a bad investment thesis at the same time. This is something that people don't understand. Whether they're investing directly in cryptocurrencies or indirectly. In fact, many people believe in something called the FAT protocol. It's kind of wonky. I'll link to some articles for those of you who are interested in diving in a little bit deeper. But the term was first coined by Joel Montenegro of Union Square Ventures, one of a very big venture capital fund in Silicon Valley, who were some of the very earliest to start making cryptocurrency and blockchain investments. And it is the idea that, unlike the generation of companies before it, where the value generated by the internet network and protocols was captured at the company level, think Facebook, Amazon, Netflix, Google, right? Mostly in the form of data. That's where really most of that value comes from. That with blockchain, the value will accrue at the protocol level or layer, not the company layer. And in his original article, Montenegro says, quote, "We see this very clearly in the two dominant blockchain networks, Bitcoin and Ethereum. The Bitcoin network has a $10 billion market cap, yet the largest companies built on top are worth a few $100 million at best, and most are probably overvalued by business fundamentals standards." Okay? So that's one. The second, and probably more of a deal breaker for me, is that investing this way would basically break all of my rules of investing, which, I've developed over a long career and have served me and my clients very well, and that they are there to serve as guardrails in situations exactly like this, right? To keep me from doing things like this. Because we're all tempted when some shiny new object, rears its head. But so let me tell you specifically what I mean when I say that it would break my rules. Specifically, investing in blockchain companies is, number one, too specific. Number two, not market neutral. And number three, not passive. So let me explain each one. I'll try to do it quickly. Too specific. So modern portfolio theory tells us that the way to construct a portfolio that maximizes risk-adjusted return over time, which is what you want, okay? It's not just return, it's got to be risk-adjusted, is to have a mix of different non-correlated asset classes so that at any given time, when some are having a bad year, the others make up for it. That's what non-correlated means. It means they don't move up and down together. And asset classes include things like stocks, bonds, commodities, real estate, cash, etc. And the mistake that many people make is in trying to, given those asset classes, right? They try to pick the individual stocks or bonds or commodities rather than just owning the entire asset class. Okay? And so we don't do that. I don't do that ever. We never, ever, ever, ever try to outsmart the market because it can't be done. I can give you a million statistics which show you that, you can't beat the market over long periods of time, right? So if that's true, then why would you try? It's like either the height of either arrogance or stupidity. So I don't try. Instead, what you do is you use those ETFs that we talked about before, exchange traded funds, to different ones that you can buy the entire stock market. For example, one ETF allows you to own every single stock in the US stock market. There's actually one where you can own, the world market if you want, right? Or you can own the entire bond market by owning the Lehman Aggregate Bond Index, or you can own, the Goldman Sachs Commodities Index. So you don't try to guess whether, meats or metals or grains are going to outperform, or, whether wheat's going to do better than oil. You just own all of it, the whole asset class, commodities, stocks, bonds, etc. The whole thing, okay? And so the reason I said that investing in blockchain companies violate this rule, even in an ETF like BLCN, is that blockchain companies aren't an asset class, first of all, okay? Wikipedia defines an asset class as a group of securities that exhibits similar characteristics, behaves similarly in the marketplace, and is subject to the same laws and regulations. Blockchain, I think I said this before, blockchain is a technology, not an asset class. So what we're talking about here is a very small subset of the equities or stocks asset class. That's the asset class, right? Blockchain companies is not. That's a subset. So that's strike one. Okay. Strike two is that it's not market neutral. If I say I'm going to, buy this ETF, this very narrow ETF with, 20, 30, 40 companies, whatever it is in it, right? It's a specific bet on a specific outcome, okay? Which, again, we don't do. So within my overall portfolio, the goal is it's not perfect but as much as humanly possible, as best as you can, to construct that portfolio so that I'm okay no matter what happens. Okay? That's what I mean by market neutral. And it's not that every single investment individually is necessarily market neutral, but that as part of the entire portfolio, an investment adds to, not detracts from, the goal of market agnostic. And the way you've done this correctly is that you stop worrying. You don't worry about volatility. You don't worry about 2004, 2005, 2006, when the market was crashing, that you can be copacetic because you've got it structured so that no matter what happens, you're okay. Making a specific bet on blockchain companies detracts from market neutral and therefore breaks one of my rules. And then strike three is that this approach is active rather than passive. And it's the same. I alluded to this above when I was talking about just owning the market. Okay. When you just own the whole market, that's passive rather than trying to beat the market. Okay. Which is active. And as a rule, I don't do because I know it's a fool's game. Okay. All right. So breaks my investing rules. Now here's the final reason I don't invest in individual blockchain companies or ETFs, is that for me, it would also be double dipping. Because think about it. If I own the stock market in like the Vanguard Total Stock Market ETF, for example, which I do, well, all those stocks are in there. I already own them. And while it isn't as sexy as saying I have an allocation specifically to blockchain companies or emerging tech, and the impact, because obviously it's spread over, I own thousands of other stocks in there as well, right? But that's okay. If blockchain is as transformative as I think it will be, well, then that will ultimately benefit every company in the exact same way that the internet has. That's what I think will happen, although I try not to have an opinion as best as I can. That goes along with being your portfolio being market neutral. I also try to keep my opinion market neutral, and just not think, right? As soon as you think something's going to happen, you get into trouble. So, the way that it works for me, I don't change things around in my portfolio, except to rebalance between the asset classes, bring them back into their percentages periodically. I mean, like when I die, hopefully a long time from now, my portfolio will look basically like this, because it can. That's how it's constructed. The only time you change allocations is because one, either your objectives have changed, your tolerance for risk has meaningfully changed, or, which, shouldn't happen very often, a couple times in a lifetime, or there's a new asset class that does a specific job in the portfolio, like crypto assets, which, oh, by the way, only happens like once every couple hundred years that we've had a new asset class, right? So with that sort of perspective, for me, buying blockchain companies just makes no sense. I already have exposure to blockchain in two different ways, in the total stock market and by owning the crypto assets directly. Does that make sense? Now, of course, there's certainly more than one way to create an optimal portfolio. So this isn't the only way to do that. This is the way I do it. But I will tell you, just before you go, discounting, there are orders of magnitude more ways to do it wrong than there are to do it right. So, thanks again, Bert and Doug, for those questions. Something for you all to consider, as well as Bert and Doug. And as always, I hope you found that helpful. If you did, you could do me a great big favor in return, which is, one, to subscribe to this podcast. And that is because the iTunes algorithm dings us for people who download but don't subscribe. So if you haven't hit the subscribe button yet, please do that so you don't miss any episodes. And even better, if you would also leave the podcast a review on iTunes with comments and feedback so we can crack the top 100 list. I sure would appreciate that. That's my goal for the podcast. If you're not sure how to leave a review for me on iTunes, then you can just go to sanecrypto.com/podcast, the same place you get the show notes for this episode. You scroll all the way down to the bottom and you'll find a link and step-by-step instructions for leaving your review. If you would like to know a little bit more about investing in crypto assets for retirement, where crypto fits into an overall portfolio, including one that's designed for retirement, I'd encourage you to register for my free online training, which again is how a little bit of Bitcoin can make your retirement savings go a lot further. sanecrypto.com/retirement. A lot of people think crypto assets are too risky for a retirement portfolio. I believe the opposite is true. I think the risk is in not investing. And in fact, for a lot of people who look like they're going to come up short, could actually be a godsend, right? So again, that free online training is at sanecrypto.com/retirement, and the show notes are at sanecrypto.com/podcast. And finally, if you have a question about today's topic, something I said, or actually anything, just email me at AskKim@sanecrypto.com. I read and answer every email personally, as well as answer some of them here on the show like I did today. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results, and all investments do involve risk. So do not, under any circumstances, invest money you can't afford to lose. That's it for me. I'm Kim Hughes. I'll be back next week. Until then, may the crypto gods continue to smile on us all.